Hi everyone, my name is Grace Tjiptadjaja, and I'm going to be doing my accounting ethics individual project on Scott D. Clark, CPA. As a disclaimer, the purpose of this presentation is to observe the public filings surrounding and relating to an individual CPA that has been sanctioned by the Securities and Exchange Commission, SEC, or another state board of accountancy. Using public filings, we are trying to get a better understanding as to why the person in question did what they did so that we can avoid similar pitfalls as we start our careers in public accounting. The presentation will also include assumptions so that we can get a better understanding as to why the individual did what they did. Background and topic selected. I chose Scott D. Clark, CPA. He earned a Bachelor's of Arts in Accounting from the University of Cincinnati in Ohio within the years of 1978 to 1983. He was age 61 at filing, which would mean he would be about 64 to 65 today. He is a CPA registered in Ohio, but does not have a permit to engage in public accounting. He is the former vice president of corporate taxation at Cintas Corporation. He was a tax manager, tax director, and vice president of corporate taxation for Cintas since 2000 before retiring from the company in 2020. This is the incident derived directly from the SEC filing, copied and pasted directly onto here. So I'm going to bullet point it and explain it in the next slide. So what happened between Clark and EY? This case involves violations of auditor independence rules by Ernst & Young, the external auditor for Cintas Corporation. Between the years of July 2009 and August 2018, EY provided non-audit tax credit and incentive services to Cintas and was paid on a contingent fee basis, meaning that a percentage of the tax benefits that EY secured for Cintas was paid back directly as a percentage of services to EY. Under SEC rules, an audit firm is not considered independent if it provides services to its audit client for a contingent fee. As a result, EY was not independent of Cintas during this 9-year period, and Scott D. Clark, a CPA and vice president of corporate taxation at Cintas, approved all the contingent fee payments to EY throughout this period of time. Further thoughts. The contingent payment system between Cintas and EY went on for almost a decade, which is a long period of time. This entire period of time, it was shown that Clark was in charge and had negotiated the fee arrangements with EY himself. As a CPA, it was shown that Clark knew that EY couldn't accept contingent fees due to their audit role and still approved every payment made under this structure. It was also shown that Clark also oversaw the employees improving the invoices for EY's payment structure. So why did Clark do this? These are the assumptions that I made, and I saw that he likely viewed the contingent fee arrangements as a smart business deal that benefited Cintas financially. He may have also underestimated the seriousness of auditor independence rules after years as a managerial role in the industry. Over time, the arrangement became normalized as no red flags were raised for nearly a decade of time. It was shown that he also relied on the engagement letters that misrepresented the true fee structure of the contingent fees as time and materials for EY, which meant that the accounts payable roles beneath Clark, who were approving these invoices, saw this time and materials on the invoices and approved them because they didn't raise any red flags. Clark also faced pressures to deliver tax savings as vice president of corporate taxation, which may have influenced his judgment and possibly assumed the risk of regulatory consequences were low due to lack of oversight or enforcement. So, what specific laws were violated? The first law is Section 13A of the Securities Exchange Act of 1934. This requires public companies to file accurate and quarterly reports with financials audited by an independent accountant. A non-independent auditor would mean invalid financial statements. So for this 9 years of filings, The SEC now considers these statements defective, which is obviously bad for shareholders and people who needed this information for their own financial situations. Secondly, Rule 13A-1 under the Exchange Act requires filing of annual reports Form 10-K audited by an independent public accountant. Third of all, the Rule 13A-13 under the Exchange Act also requires filing of quarterly reports, Form 10-Q, to be reviewed by an independent public accountant. And then finally, Rule 2-01C5, Regulation S-X, states an auditor is not independent if they provide any service to an audit client for a contingent fee. So, what was the punishment by the SEC? Clark was barred from practicing as an accountant before the SEC. He must wait 1 year before applying for reinstatement. He must meet strict conditions for reinstatement, including CPA license and audit committee oversight. He was issued a cease and desist order to prevent future violations of Section 13A, Rule 13A-1, and Rule 13A-13 of the Exchange Act. Respondent Clark shall, within 14 days of the entry of this order, pay a civil money penalty in the amount of $30,000 to the Securities and Exchange Commission. Punishment by Ohio. It was shown that no enforcement actions were found in Ohio. His CPA was already surrendered in January of 2020, even though the SEC filing was finalized in December of 2021. So his CPA was already not registered a good about 2 years before the incident was finalized. But obviously he was an active CPA for like a good amount of time before, because obviously like the contingent fee payment system happened for 9 years. So he was an active CPA for at least some of those 9 years. Post-incident. Scott D. Clark retired from Cintas in 2020 before the investigation and SEC order was finalized in December 2021. Which I found that I think it's like such a coincidence that that he was able to retire right before the SEC order was finalized in December 2021. He now just works as a manager on his wife's business called Kelly Clark Design and has been working part-time as a manager for about 5 years. I wanted to show you guys his LinkedIn also. This is Scott Clark. This is what he looks like. Because when you see the name, I feel like you don't really connect it with a person because of this, like, he's just like a white collar crime. Like, you don't really consider who they are, but this is what he looks like. And he's just a guy who, like an average guy, like he could be like you and me one day in the future. And he's just now like a manager at his wife's company at Kelly Clark Design for about 5 years. And it shows his previous experience at Cintas and his education, just like any one of our LinkedIn's would show. Yeah, personal thoughts. As I think about this case, I wonder if Scott Clark truly understood how serious the issue was, especially since he hadn't been actively practicing public accounting for a long period of time. It's possible that being in a corporate role for so many years, he became distanced from the evolving independence rules and underestimated the implications of what seemed like a routine business arrangement. Obviously, this doesn't excuse the violation, but it does make me reflect on how easy it can be for seasoned professionals to lose sight of compliance when they're far removed from the public practice, and how important it is for all CPAs, regardless of their role, to stay grounded in the fundamentals of professional ethics and regulation. Especially if a person like earned their CPA at maybe 20, 22, but this incident for Clark happened at 60. So imagine about 40 years later to keep up with all of the regulations and laws that may change over that course of time. My final thoughts and takeaways. This just reminds me that independence is essential. Even behind the scenes decisions can compromise audit integrity and legal compliance. Uh, Being a CPA carries long-term responsibility. It reminds me that a CPA isn't just a title. It displays the information that you're supposed to know and that you should know as a certified public accountant. Your ethical obligations don't end when you leave public practice and stay in managerial accounting, just like Clark. It shows that you need to stay current in your continuing professional education, especially on independence rules and ethics as you move up in your career. Leadership actions may have ripple effects, and what you approve or ignore can impact years of financial reporting. It shows that even if you're in an accounts payable role, you need to be a little skeptical of all of the invoices shown and why are we paying this invoice and why, where is it coming from? What is it for? And finally, don't let comfort turn into complacency. As shown by Clark's long professional career at Cintas, career longevity shouldn't mean losing touch with regulatory standards and legal compliance. He should have known that the compliance, I'm sorry, he should have known that the contingency fee payments were not allowed for EY, but he still continued to do it for this long period of time, not just a year or two, but for 9 years. And it shows how desperately maybe he wanted to make money and keep money for the corporation, but it also shows how easily he was able to just keep doing wrongdoings year after year. It shows us as future accountants and future auditors how scary it could be and how people can just as easily make a mistake like that and keep on doing it. And that's why it's important for us as incoming auditors and accountants in the future 2025, 2026 years of employment to really look out and understand how accounting works. Thank you so much, guys. I hope you guys all have a good day, and thank you so much for listening to my presentation on Scott D. Clark and how it applies to our lives.